What we will do is now get involved and discuss the FTSE 250, see how that differs to the FTSE 100, and more importantly, what are the pros and cons, what sort of investors are going to benefit from the FTSE 250 as opposed to the 100, and what diversification benefits can there be. When we talk about the FTSE 250, we in essence mean companies 101 over to all the way down to 350. You will see sometimes FTSE 350 advertised. In essence, that's just combining the 100 and the 250. It's not a separate index. So the key part about the FTSE 250 that we will come to realize is you will now start to get more of a UK focused, more British companies listed on this main exchange. You're not going to have too much international involvement, and that will naturally pose its pros and its cons to that. And second of all, the market is again weighted via market capitalization. So these are fairly large companies, but not as large as the ones in the 100. So you will now start to see the effects of liquidity and so forth. And we will discuss that in greater detail coming up. Okay, great. We're going to look into some of the key characteristics of the FTSE 250 and what really separates it from the FTSE 100. One of the key impacts is investment trust, and if you're not sure what an investment trust is, it's very similar to a mutual fund. In essence, a trust which is actively managed or passively managed, whichever way you look at one, and investors pool their capital together, and that pool of capital is diversified into multiple different sectors, or it could be very much commodity focused. So depending on what the objective of the trust is, the money will be allocated accordingly. Now, the shares will be listed on the FTSE 250, so you can acquire an interest within the investment trust like you would acquire any other share. There will be a share price attached, and you're more than welcome to buy and benefit from the performance of that investment trust. That's one of the key characteristics and what drives a lot of investors. The sectors are incredibly diverse. As with the 100, you do still have your financials, industrials, healthcare, but be fully aware they're not going to be as large as the ones represented in the 100, so they are more susceptible to aggressive price action, so you have to be fully alert. One key component, or one key sector that investors focus on, is the technology sector, and within the FTSE 250 they have a higher representation of technology companies compared to the FTSE 100. So this does signify a lot of growth within the sector overall. And one big difference between the 250 and the 100 is the UK focus on the 250. As you know, within the FTSE 100, majority of the companies, their operations are based abroad, and they predominantly deal and report within dollar. So that market is a lot more heavily weighted towards the dollar. Whilst with the 250, it is now focused very heavily on sterling. While there are some companies which have international operations, the index is generally more focused on companies with presence within the UK, which is important, especially for investors and fund managers, for example, who do use it to gauge the overall health and trends within the UK economy. So it's a great way of benchmarking, especially if you've got predominantly UK companies. So when it comes to the pound overall, the 250 companies are more sensitive to movements in the value of the pound compared to the 100. That's not to suggest that the 100, the FTSE 100 would take kindly to the sterling devaluing heavily. It's just not as closely linked. So, as the sterling strengthens or weakens against any other currency, the value of those companies, earnings will be massively affected. So a weaker sterling may actually boost our competitive nature in the UK export market, but may also impact the profits of companies which have international operations. So it's something to be aware of. But in a nutshell, within the 250, trusts play a big part in drawing investors. You do have diverse sectors, as well as having the inclusion now of a lot more tech stocks. And now there is a more UK focus. So sterling has a big impact on companies' earnings, and in turn will affect um, their revenue, and if investors are looking to want to invest in that company or not. And 250 would be seen as a good benchmark to see how well the UK economy is performing overall. The FTSE 250 will vary from the FTSE 100 in many departments, and that does also include liquidity and volatility. As we know, liquidity is the ease in which you can sell the stock you have into cash at the price that you want. With the FTSE 100 being massively liquid, um, the 250 in some cases will not always be the same. A lot of the companies will not have the same sort of volume of buyers and sellers or outstanding shares in the market. So that could mean that you may be more susceptible to price gapping or aggressive selling. Okay, so it's not to suggest that most of the companies are illiquid. It would be far from that. But there are more aggressive price actions within the 250 than there are within the 100. Okay, so that's one thing to be fully aware of. The volatility goes hand in hand with the liquidity. Naturally, companies which are not as large in size, does not have as many buyers and sellers, will experience a lot more volatility. And these companies are more susceptible to economic conditions, change in GDP, employment rates and inflation, especially UK data. Interest rates decisions are going to have a big impact onto the volatility. Corporate earnings are naturally seen as a great opportunity to make a quick profit at times, especially if you're results trading. And corporate earnings within larger organizations may not be that massively impacted, but if you have a smaller company which is still very much within its growth phase and is experiencing very negative set of corporate earnings, that will have a big impact on how investors will see the companies. Okay, so if the markets or if the reports are negative, you more than likely will see a lot more aggressive selling than you would in, for example, a FTSE 100 company. Global events play a very big part, especially if it leads to weakness within our country as a whole. And then you will get elements of, investor sentiment. There's not a lot of news that circulates around some of these companies. So it is very much a case of whatever you do here can have a big impact. So investors are always very wary of, not necessarily wary, but they are aware of the fact that they do take slightly more of a risk when investing within the FTSE 250 than they would in the FTSE 100, for example. Okay, when we talk about the type of investors, they will vary slightly within the 250 as per the FTSE 100. We are well aware that the FTSE 250 is slightly more illiquid, slightly more volatile, but a lot of the pros attached to it, the fact that there is elements of a technology sector, and investment trusts are heavily listed in the market. So from a retail standpoint, you will get investors who are prepared to take an extra degree of risk for potentially further upside by way of growth. They may wish to diversify their portfolio further by looking to invest in investment trusts. So that's one aspect. Institutional investors will still feel very much that way as well. You will get pensions, you will get pension funds, insurers, as well as banks prepared to take on additional risk. And actually, risk-tolerant investors are happily able to park a percentage of their capital within the FTSE 250. Age bracket may come into it. The slightly older you get, the more risk averse you are, the more focus on income planning may draw you away from the 250. But slightly younger investors or investors with adventurous growth aspirations may want to be focusing on the 250. And as mentioned earlier, you can be sector specific. You can focus on the tech sector. You can focus on investment trusts. So it does vary slightly to the 250 to the 100, and it's still a great opportunity, especially if you are looking to advise clients or make them more aware of the 250 companies. Okay, looking at the pros and the cons to the FTSE 250 will allow you to, speak to your investors, speak to your clients, and make them fully aware of what can be achieved in the FTSE 250 and what cannot be. Okay, so when we look at the pros, we look at the growth element. There is potentially greater growth within the FTSE 250 as compared to the FTSE 100. That's not to suggest that companies within the FTSE 100 are hitting a ceiling. It does suggest, though, it may grow at a slow. Certain companies may grow at a slower rate, and FTSE 250, they are still in their expansion phase. They are still picking up market share, so it could be a great opportunity to invest in the FTSE 250. Diversification is important, not necessarily diversifying within different sectors, but diversifying across different markets and diversifying across different risks. It's great to have exposure to FTSE 100 companies, but it's also great to have exposure to small cap and mid cap stocks. They do allow for potential accelerated growth, but on the downside to that, of course, they may not reach the potential that they thought they might, and in turn, you will tend to see some aggressive selling at times. Innovation, when it comes to the 250, we have mentioned there is a lot more of a tech focus, not a lot, but there is an element of tech companies as well as investment trusts. So it is slightly more outside your usual construction of a portfolio. So it does have that innovation element. Undervaluation is important, as some mid-cap stocks may be overlooked by investors, leading to potential opportunities for undervaluation. So if the market underestimates a company's growth, for example, there may be a lot more room on the upside for the company to grow. And there is always the possibility of M&A activities, mergers and acquisitions. Remember, these companies are within their growth stage, some of them. Some are naturally been around for a number of years, so they're not at their growth stage, but they haven't accelerated on to that next level. So larger companies may decide to say, you know what, it would be a great acquisition to have that company on board, and that naturally would inherit, clients, capital, and contacts and so forth. So when it comes to the cons, there will be a lot more volatility attached to mid-cap stocks. It can result in, more aggressive movements on the downside, not only on the upside, and that can be a result of economic conditions and so forth. There will always be liquidity concerns as they are less liquid. There's not enough buyers and sellers at times, which can impact the overall stock price. Limited resources, if you look at FTSE 100 companies, they would never really be disrupted by economic downturns or any sort of disruptions because they have enough capital and resources to counter any sort of negativity, while smaller companies or mid-cap companies won't have that sort of flexibility. And when we talk about less coverage, I mean by way of less visibility. You don't tend to see a lot of FTSE 250 companies within magazines and newspapers. Analyst coverage tends to be very limited, so it results in a lot fewer sources of information for investors to make informed decisions. So if you can't see something and you don't know what it is, you don't tend to invest. So that's what can be a big risk. Board level risk is a massive impact on a managerial standpoint. In a FTSE 100 company, MDs, change over, on a regular basis. It doesn't tend to have an impact. But when it comes to the FTSE 250 and small cap, you will tend to see if management are uncertain, if management tends to leave, that tends to spell weakness. It could be, poor leadership, poor decision making by them. But by them leaving, whether they resign or they're fired, will have will send tremors really through the overall company. And from an investor standpoint, you might be like, you know what, I might want to stay away from this company. Whether you decide to take your money out of it, you may also decide to short it. Okay, so that's one thing to keep a keen focus on. Markets are a lot more, or the 250 will be a lot more susceptible to economic and geopolitical risks, especially if it's going to be currency related risks as well. So be fully aware when you are speaking to a client. In a nutshell, always encourage diversifying, taking on board additional risk within reason. They could dedicate 5% of their portfolio within small cap, mid cap companies. So it's just a way of spreading risk and making investors aware of a wider market.